Climate Change Committee's webinar on climate risk and adaptation, financing a resilient, climate resilient UK. We'll wait for up to a minute before we start in earnest. So thank you for joining us. So, as I said, good morning and welcome to the Climate Change Committee's webinar on financing a climate resilient UK. I am Ece Ozdemiroglu. I'm an environmental economist, a director of FTEC, and a member of the Climate Change Committee on the adaptation side. And it's in that capacity that I have the pleasure of welcoming you to this webinar. This is one of the deep dives the committee has organized following the publication of climate change risk assessments in June this year, and it gives us the opportunity to contribute to the conversation and action. Today, we're covering financing a climate resilient UK. We will start by a short presentation by David Style, who's an economist at the committee's secretariat. David is going to take us through the key messages and coverage of the climate change risk assessment in this topic, in terms of the need for adaptation, the need for investment in adaptation, and returns to such investment. However, this topic is relatively new for the committee, so we have gathered 3 panelists to help us unpick the what's, whys and hows. And the panel consists of Helen Avery from the Green Finance Institute, an intermediary, if you like, in the marketplace, Sam Evans from Greater Manchester Combined Authority, a representation perhaps for the providers of investment opportunities, and Robert Hall from Federated Hermes, an investor, but also playing roles as buyer, seller and intermediary. And perhaps we will find in this discussion that those roles are actually much more fluid than we think for everyone involved. After David's introduction, we will have a panel discussion and we will have time to come back to your questions and commentary from yourselves. If you're in the Zoom webinar, do please use the Q&A function, and you can also vote up the questions that you'd like asked. I will try and incorporate the questions as we go along in the panel discussion, as well as the Q&A section at the end. So thank you for joining us, and we now go over to David to give us his presentation. Thank you, David.
Thank you, Ece. So in this presentation, I'm just going to provide a brief overview of some of the key parts of the CCC Adaptation Committee's advice to government as part of the 3rd UK Climate Change Risk Assessment. Next slide, please. So the assessment draws on a very broad evidence base made up by a technical report of 7 thematic chapters. The findings from these chapters were distilled through several national summaries and fact sheets, drew on supporting research on valuation and projections of flood and water and many other dimensions. And the committee gave its advice to government in the form of one advice report, which synthesized all the other findings in the assessment. Next slide, please. So one of the key findings of the assessment is that the level of urgency of adaptation has increased since 2017. Of the 61 risks and opportunities assessed as part of CCRA3, a higher proportion relative to the previous assessment were scored as more action needed. The reasons for this change, one was that the new evidence since 2017 suggested that the level of risk was higher than previously assessed. And the second related reason is that As a result, the gap between the level of risk and the level of current and planned adaptation has widened. Next slide, please, James. The committee identified 8 high priority areas of further adaptation in the next 2 years. These were selected on the basis of the urgency of additional action, the gap in UK adaptation planning, the opportunity to integrate adaptation into forthcoming policy commitments, and the need to avoid locking in poor planning, especially as we recover from the COVID-19 pandemic. The first 4 of these high priority areas relate to different aspects of the natural environment, and then the other 4 include the collapse of supply chains and distribution networks, failure of the power system, increased exposure to heat in homes and other buildings, and multiple risks to the UK from climate change impacts overseas. Next slide, please, James. In addition to assessing the risks and thinking about the benefits of adapting now, the committee also reviewed the evidence on the adaptation gap in the risk assessment and looked at how adaptation is being implemented. From that, it drew out 10 principles for effective adaptation. Some of these principles are about good long-term planning, such as integrating adaptation into other policies and planning for both 2 and 4 degree warming levels. Others are about making decisions that maximize benefits over costs, including avoiding locking and also assessing and addressing inequalities and ensuring that any adaptation actions don't exacerbate existing inequalities. All of these principles need to sit within a vision for a well-adapted UK so that there's a clear aim, and they need to be underpinned by proper funding, proper resources, and key metrics. Next slide, please, James. Other key messages relating to the funding of adaptation included that there are several financial barriers to taking action, varying by sector. There are new initiatives and financial products which are helping to address some of these funding barriers, but these need to be scaled up to meet the extent of action required. Green finance offers the potential to fund adaptation actions with wide-ranging benefits across climate change mitigation, adaptation, and biodiversity protection. And government has a primary role to play in ensuring that adaptation is integrated, adaptation and resilience are integrated into our financial system and existing economic plans. Next slide, please, James. Okay. We are building a better, we're missing a slide here, but I'll just talk about it instead. So we're building a better and better understanding of the economic benefits of adaptation actions. The evidence from CCRA3 suggested that adaptation has strongly positive benefit to cost ratios. The benefits that we looked at included a mix of financial revenue generated, financial cost avoided, and non-financial or non-market social benefits. Across the board, acting early typically has much larger benefits than delaying and taking action after an impact has already occurred. So that concludes my presentation, so I'll now hand back to Ece.
Thank you very much, David. I think that what we want the panel to be is a conversation, so you won't see any more slides during this webinar. And it's I'm very pleased to say that panelists are willing to share their experiences, but also tell the committee what they would like the committee to do, as well as everyone else, all the other stakeholders in this field to contribute to. And David's final point about a mix of returns was going to be my first question to the panel. We might have, outside the finance investment field, we might have the perception that investors are only interested in financial returns and perhaps only interested in financial returns now or certain returns in future. But the picture is not that for adaptation. There's mixed returns, as David listed. What's the interest? How are you going to cope with these mixed returns? How are you going to cope with complexity and uncertainty when you invest in adaptation? Perhaps we start with Robert on this one as working for an investment firm, and other panelists will come in as they see fit.
Okay, thanks Ece, and thanks David for that presentation. That was really fascinating, actually, and I think with all these, this is a classic topic where trying to summarise in 5 minutes is extremely difficult.
It's only a starter.
Yeah, I'll try and speak in bullet points and not be totally comprehensive, otherwise no one will have a chance to speak. But in simple terms, I think if we're talking about, for instance, kind of nature-based solutions, I know that's particularly popular topic at the moment, and so we're interested in, and spending a lot of work on. Investors are not, quote, just interested in returns. Investors do, however, operate within, I think, firstly, there's different types of investor. So things that often are kind of, I think, less understood than they could be. Different types of investor with different hurdle rates, so different return requirements. But all investors tend to operate within institutional and kind of quasi-legal parameters that restrict their choices. And I think there's an entire kind of structural logic underneath, quote unquote, private investment, in particular related to things like fiduciary duty, which often I think those on the other side of deals don't quite understand. And I think there's an idea that there's a kind of element of discretionary choice going on within an investor about, oh, how can I maximize my return on this? And if I don't get X, I'm not interested. It's always a little bit more nuanced than that. And with nature-based solutions that can increase climate resilience, it's a particularly unique, I think, kind of emerging asset class. The nuance there lies in, so is there a hurdle rate? Is there an established expectation of return? No. So you're right, Ece, there's different rates of return, different profiles for different kind of sub-natural asset classes. Are investors willing to accept a below market rate of return for investments in nature-based solutions? Yes, but it depends on which market and how you're defining it. So, for instance, you're looking at this as I will stop here, otherwise I go down a rabbit hole. But if you're looking at this as a kind of natural infrastructure, or if instead you're looking at it as a kind of like an enterprise level, kind of private equity view, they come with different rates of return. So there is no simple answer to that, but the quick answer is investors are not just driven by return in this space. And I think those investors that are managing to make feasible direct investments into nature, increasing climate resilience, are able to do so and are able to make it feasible because they understand, I think, a couple of things. One, the points that Dave was talking about, this kind of ripple effect of indirect benefits, co-benefits, and social impacts. I think where investors are able to quantify those tier 1, tier 2, tier 3 impacts and be able to value them, that begins to suddenly the asset you're looking at has a completely different profile than if you're just looking at kind of a direct price or market realizable price. So I think quick answer is yes, investors are willing to invest in nature, probably for below what we would think of as a market rate of return, but they are not willing to forego return. The nuance is in negotiating that middle ground, and of course in understanding the risks that sit underneath that. I'm sure we'll come on to the role of kind of the state later and public funding and how you can use public finance to leverage and juice scale, in the jargon, private investments into nature. So I won't touch on that now, but it's not black or white. It's feasible, but it's always nuanced, and it's particular to the investment. It's place specific and it's asset class specific. That's a start for 10.
Good to hear it's not black and white and a definite no or yes. Helen or Sam, would you like to come back or add on to that? Helen, I see you're off mute. Yeah.
Sure. Yeah, I mean, totally agree with Rob that every investor is different. I mean, and I personally would like to see more sort of philanthropic funding coming in to take a slightly more impact investment type role of taking those low returns. I think that's a gap that we have at the moment. I'm not quite sure why that's not happening. But I mean, to the point, it's really sort of a market imperfection, isn't it? That the benefits to society of some of these interventions just don't generate additional cash flows, and therefore they're not capturing the financial return. And there was a report, I think it's a couple of years old, but it looked at some of the business cases of private investments adaptation. Like 80% have provided benefits beyond the investor. So how do we capture that? And those positive externalities aren't just, you know, the things we think about like social benefits, health benefits. They're also, you know, technology spillovers, sort of learning. Some of the learning that comes out of these projects is really valuable. So I think it's, you know, totally agree with Rob. There are some models that I'm sure we'll talk about, especially when it comes to using public sector finance to de-risk some of these. But there are models out there of private investment where they've managed to sort of capture a value of those positive externalities. And there's one I'll just give you really briefly, and then I'm sure Sam's got a lot of examples from Manchester, but it's a really old one. It was 2001, the government of Malaysia, they developed this concept of a mixed-use tunnel that allowed for traffic flow under normal circumstances, and then acted as a stormwater diversion after heavy rains. And that road was a toll road in parts, so that helped sort of pay for the sort of development of the tunnel in the first place. So there's sort of nifty ways of sort of using positive externalities in sort of more creative ways when you're structuring a private finance deal, but I'm sure we'll talk about more later.
Yes, Sam. Thank you, Helen. Yeah.
Yeah, I think Robert and Helen have I think made some really good points there. I think from a kind of local authority, local government perspective, we see different, as Robert was saying, different. It's not black and white. There's different types of investors with different drivers and different interests. And as a local government, I think we are trying to find a role in bringing those different investors together and recognizing some of that. As has been said, I think the role of impact and philanthropic investment in buying those social impacts, those benefits that don't generate cash flow, is particularly important, and I think we'll come on to the role of government finance in reducing some of that risk. But those are certainly the models that we are looking at within Greater Manchester of incentivising and bringing in funding into adaptation, is bringing those different parties around the table and having conversations about returns, benefits, impacts, and how that can be made to work in a project, a program basis. And I think we are seeing increased interest in those sort of non-tangible, non-monetizable benefits within local areas, and the appetite, particularly thinking about carbon, for companies to invest in local projects so that have a local impact within their communities, and valuing those wider benefits, the learning that Helen mentioned, the social benefits, educational benefits within the area as well, and seeing those wider, the value of those wider benefits where they are operating.
Excellent. So I'm hearing that it's important to know who you're dealing with, and it's the same, isn't it, when you're looking into a new market? You think everyone is the same, but there are many different types of investors, and how you're packaging a deal together. And that kind of leads me to my next questions. Who is then financing adaptation at the moment? Can you give us some examples? How are they doing it? Why are they doing it? It'll be refreshing to hear the good examples. We can return to the barriers after that.
Ece,
like to go.
Can I be very cheeky and just come back on the last round of responses, and then I'm happy to, if you'd like, happy to segue into your answer. But it's just, I think all the other answers help to kind of clarify things, and the point I was trying to make. I think one of the interesting things about this area is sometimes your first question, the suspicion of the role of private capital. I think the innate suspicion actually is in itself a kind of cultural obstacle that ironically prevents capital. And we talk about impact investing. Often the work I'm doing is attempting to establish feasibility of impact investment models. And if you want to scale this up, you cannot just rely on philanthropic funding. If you want to go just one notch down the scale, you're into impact. Even impact investing requires, you can't be losing money. So if you're acting under fiduciary duty, you can't be ending up in negative equity knowingly, even if you're an impact investor. So if we start from the point of an impact investor wanting to do good, quote unquote, often when we talk about the use of public funds, let's say at a local or authority level, but it could be national, it could be in any regional level you like. It's this phrase de-risking gets used a lot, and it's an accurate phrase. It's de-risking because it's providing some certainty of a kind of a realizable price or realizable return. But it makes it sound a little bit, I think, like it's kind of doing a favor or facilitating purely facilitating returns to private capital. Actually, what's quite special about this asset class is that often it just involves, you call it private capital and public capital, but people on both sides of the deal sitting down together and attempting to value in kind of real life, in real world impact, real world terms, to those numbers of tiers I described to us, what's the direct impact? What's the indirect impact? And one of the big things I think is quite interesting is it actually requires at the level of public authorities. And I say as somebody who used to do cost benefit analysis within public sector, so I have some sympathy, a fundamental reconceptualization of the use of public funds and a de-siloing of all these different kind of divisions within local authorities. So you've got your local health part, and then you might have your other part, and then everyone's dealing with a little different piece of experience of life. And actually, local authorities and the public purse can ultimately save on this avoided cost base that David save a lot of money. So is it about private capital attempting to convince the public purse to facilitate massive returns to private capital by de-risking? It's actually more accurate to say what we're looking to do is simply find a way to realize the real financial benefits of this activity that are simply not being priced at the moment, because economics and economic theory and the way that, you know, chief financial officers within local authorities work is then simply not methodologically and instrumentally capable of actually valuing that and on a net basis understanding the avoided cost at a place level, not in a divisional level. That's actually one of the key things that you could do to unlock that massive scaling, but it's the innate suspicion of private capital, I think, in the first instance, combined with the methodological kind of siloing within local authorities that is kind of blocking this at the moment. Shall I segue into the actually answering your question? I'll do 30 seconds. And
yes, give us a good example where we can break those silos. Yeah.
Well, you mentioned impact investing. Why am I attempting to establish a kind of feasible model for this? Why is Federated Hermes interested in this space? Well, it's in honest, it sounds trite, but it's to have an impact. So first thing is, to what extent we're aware of some of the obstacles. So to what extent is it possible for a private investor to invest in nature such that they deliver in a way that I think public authority stakeholders want, national trusts want, wildlife trusts want, this kind of decade-old kind of community that has established under the nascent work to establish the UK's market and ecosystem services and natural capital. Has a very, is very wary of potential kind of a bad version of this market. Now we thought, how can we do the good version? To what extent can we make that feasible and still generate a return or not end up in negative equity? And that doesn't mean you have to end up sacrificing the fidelity of the ecosystem services. So we do it for impact, environmental impact, ecological impact. Specifically, we're interested in, when we talk about carbon sequestration, I think, again, we're into this murky territory of this scale in the offset market. But actually, even if the approach we take is one based on, we say with climate science. So what I'm actually looking at is I look at carbon budgets. And no matter what scale carbon budget you're looking at, there is carbon removals implied, and obviously you're at the CCC here, so everyone's very familiar with that. But what I'm talking about isn't an offset strategy. It's a carbon removals technology strategy, and to what extent can private capital play a part in providing those carbon removals that are implied by the budget? That's one of the key reasons. So carbon sequestration is a driver. But again, we're into the nuance of, are you a cynical offset generator with no mind? Is it linked in any way to a carbon budget, or are you just trying to generate as many as possible? Or can you kind of describe and define what it is you're trying to do in the context of proper carbon budgets, quantify the carbon removals? Are you trying to certify these products so that everyone can be aware of what you're doing? Is it black box, or are you looking through it? So we're trying to have a sort of transparent impact product, generating social impact, environmental impact, carbon sequestration, biodiversity net gain, I would say environmental net gain, whilst making the lower level of acceptable institutional return. That's the quick summary.
Thank you, Robert. Sam, I'd like to come to you next for an example, because Rob mentioned local authorities, public sector a lot, but also the importance of doing this kind of return analysis at a location-specific level, and that's where you work in. Do you have any examples of how you're tackling this challenge?
Yes, yeah, and just to come back on Robert's points previously, yeah, I completely agree, and we are, within Greater Manchester trying to bring together different investors to have those sorts of conversations at a place level and break down some of those misunderstandings and perhaps barriers to having those conversations and suspicions. And I do think that the way local authorities have been kind of forced to operate over the last 10 years or so hasn't helped that sort of siloization, and government is the same in terms of its siloization of budgets for specific interventions without bringing those together. In terms of examples from Greater Manchester, we're looking at some of similar things to what Robert mentioned there. So we have in the last 6 months set up a Greater Manchester Environment Fund that is there as a kind of long-term strategy to start and be a vehicle that can start to bring in these different types of investment, public, philanthropic, shifting that dial towards impact and mainstream investment, and growing the market for investment in the natural environment within Greater Manchester, and providing a charitable vehicle that's able to bring in those different sources of investment and direct them into the projects that we know are out there and that need funding. And that's also bringing in capacity to help develop these projects, and project development is maybe something that we talk about later, but that's, developing the projects so that they can be taken to investment is a real challenge and gap in this space. So we're developing, particularly focusing on developing a model around capitalising on biodiversity net gain, which will obviously, when it comes in, and we're bringing it in sooner in Greater Manchester than nationally, we'll start to create a market for nature recovery, for habitat restoration, and stacking that alongside carbon offsetting at our peatlands within Greater Manchester. So we've got for an urban area, expansive degraded peatlands where there's significant opportunities for habitat restoration, for carbon sequestration, and for those wider benefits that we talked about as well, for education, for water quality, for flood risk reduction. So we are over the next 12 months or so hopefully developing a model that then we can demonstrate that works, and hopefully scale that up to other parts of Greater Manchester and take that learning elsewhere. So that's where we see particular opportunities for us around biodiversity net gain and carbon sequestration in areas where those can be brought together. And there's live work going on the ground in parts of Salford and Wigan now to start that process.
Thank you. We will watch them. Helen, do you have any examples to add?
Yeah, I think it's just worth pointing out that we really don't have much insight into private investment in adaptation, actually, just because, some of it is part of other deals. There's infrastructure that doesn't get accounted for. There's not sort of disclosure or transparency around adaptation as opposed to mitigation, where we have got a lot more insight. So I think we clearly need a lot more. I'm not saying, no, I think there's loads. It's hard to get a grip on what is actually out there. There are some really interesting examples, I think, worth noting. I always think stormwater retention credits as a market in the US has been really interesting. The Natural Capital Finance Facility of EIB offered a loan to Athens to reduce its urban heat islands. That was a sort of interesting model, though, using public sector finance for a loan. I think in the UK, the use of local climate bonds or community municipal investments is worth exploring around adaptation in particular. And then the River Wire that everyone's talking about at the moment in the UK, I mean, that model is an adaptation model, really, because it's reducing flood risk. And there are organisations paying for those benefits that are allowing investors to come in. And then the other one I heard about recently was parametric insurance. A cattle farmer in Africa, typically in a drought season, his cattle may die and the insurance company has to pay up. So the insurance company has developed technology where they track the moisture in the grassland, and when it goes below a certain amount, then they'll send the farmer water and feed so they can keep the cattle alive, making the farmer much happier and the insurance company much happier. It's a complete win-win. So there are examples out there. They're just few and far between, and it'd be great to sort of just have more eyes on them and start capturing more of that, so we can get it out there and have more thinking around it. But I think there is not a shortage of smart people who are working to come up with some solutions if we can just sort of lift those up a bit more. And obviously what we're all looking for is scale in the end.
Yes, this sort of collation of examples was something that I was also going to raise, because I saw, for example, in the Woodland Carbon Code in the UK, you have a carbon registry of people who are using the code and buying offsets, but there isn't that kind of a database of people investing in adaptation. And presumably it could be possible to create such a database whilst respecting commercial confidentialities, just to sort of spread the examples, share the love. Maybe it's something GFI and committee could talk to each other about setting up something like that. There is a question related, kind of related in my mind anyway, in the Q&A here, is that obviously there's a target for mitigation, there isn't a target for adaptation. Would having a target for adaptation, however you might want to define it, help motivate more investment into adaptation? How would you have it? Yes, please.
I think we've been having those conversations within the CA just in the last week, really, and the focus that obviously the Mayor setting a 2038 carbon target has had. I think it potentially would help, but it is complicated. And I think one of the benefits of action on adaptation is obviously all of those other multiple benefits that we were talking about. And that makes talking about the natural environment quite complicated because of those wider benefits, not just for the innate value of nature, but all of those environmental benefits of carbon, flood risk management, water quality, and for educational, amenity, recreation, mental and physical health. So it becomes setting a target for all, because potentially these projects will be tackling all of those to a degree. It makes setting a target quite complicated and also potentially dilute some of the benefits for us of talking about all of those other benefits that adaptation action brings. So it's not an easy task to set something like that, because you do risk missing the kind of wider benefits and the wider picture.
Okay, Helen, did you want to come in on that?
I think it would be really helpful for obvious reasons, because it starts sending the signal out that we need to sort of do more. I'm a bit concerned about the number of different targets out there, and if they don't quite align, then what does that mean, and which one do we go with first? I'm just thinking, if you have an adaptation target that might inspire MBS in one area, and then you've got mitigation targets that don't match that, well, what are we going for? So I yes and no, I think, would be the answer from me.
Robert.
Yeah, really interesting. I think I agree with what both Helen and Summer said. Really, I think on it sort of diluting some of the underlying pillars, if you like, that actually compose it in targets relating to that. I think that's definitely a risk. I think sometimes, I hate to say it, but I think sometimes the phrase kind of climate resilience can be a bit vague, and people don't really understand in definitive terms what we're describing. I'll try and give a tangible example as a way of just describing my own thinking. There's some work going on so I'm a member of the Yorkshire Climate Commission, and in some of the thinking going on there is around, or at least let me speak personally so that other commissioners don't get annoyed, but my own idea in terms of trying to develop a financing platform for financing the just transition, and that would include mitigation and increasing resilience. I tend to find that it's helpful to have one hard target in your head. So I quite like net zero. I mean, it's not controversial. I quite like net zero as a kind of overarching framework underneath which you've got kind of, I suppose I'd always link mitigation and resilience and adaptation. I know that, again, there's controversy about all of this, but underneath these thematic kind of headlines, if you like, these phrases for targets, there has to be specific, I call them asset classes, but specific targets and specific quantifiable kind of actions that you need to take. So we haven't talked about the built environment today, but the way I always think about this is kind of actually, when we talk about resilience, it's the kind of nexus between the natural environment and the built environment to a large extent. A lot of the things we're talking about are about that. Within the built environment, I'm kind of encapsulating kind of people's everyday lives, the way that they experience place. So that's really what we're talking about. And so within that, you can begin to define, this actually helps from a kind of investment point of view, you can begin to define specific areas like retrofit of housing or design of new build, and we talked about heat islands, All those kind of things related to the built environment. And then, of course, they interact with FM schemes, natural flood management schemes, and other nature-based solutions. One of the things that I tried to do a little while ago is to try, and the Environment Agency were doing an amazing bit of work on an FM scheme in Yorkshire. And one of the things we were trying to do is to combine, I think me and you chatted about this, Ece, a natural capital account with a hydrological risk model, and then in some way try and internalize that into a buildings insurance model. It didn't work in that particular context for interesting reasons to do with the insurance market, which I won't go into. But I think the point is that actually, when you're talking about investments into nature-based solutions, for instance, some of the issues around the fact that sometimes you can end up in a kind of negative equity space without public funding. An alternative solution to that is blending, creating a novel asset class where you will blend, you create a security that is at once a kind of a debt investment into nature-based solutions and, let's say, property retrofit. And you do it on a place-based level. So we talk about place-based impact investing. There is a way to invest in multiple different assets within a particular place, all thematically linked and all interacting and related to climate adaptation resilience. And incidentally, by the way, that does tend to have an effect on the return. So you can blend the return, it becomes more attractive. I won't go into the details of why, because that's the secret sauce. But that's my thoughts rambling on that question.
So perhaps what I'm hearing from you, but maybe because that's what I think as well, is that maybe adaptation is not so easy to link to one target like net zero, because adaptation is in every part of life, in every sector, in every environment, natural or not. But it is possible, perhaps there's a suggestion in the Q&A to actually think about the committee's recommendation that think about 2 and 4 degrees. What do 2 and 4 degree worlds mean for your goals, for your area of activity? And what do you need to do to adapt to worlds like that? That could be an overarching message, perhaps, that sort of satisfies Helen's yes, but. And this kind of local approaches, we're trying to spread people's sort of scope of analysis. We're not trying to narrow it down to one benefit. There isn't an adaptation benefit. There are many adaptation benefits. Perhaps you're nodding. That's good. Although we don't all have to agree. If we all agree all the time, that wouldn't make a fun panel. I'd like to maybe go on to something more kind of difficult, in the sense that we talked about uncertainty, we talked about multiple benefits, data, etc. So, and it's still very small percentage, even if we don't know how much money is being invested in this. We do know it's a very small percentage of all investment. What are the key barriers you think that we need to address as priority to move more investment into this area? And how you would recommend?
Shall I have a go? I mean, there are so many barriers, policy, regulatory, financial barriers, information barriers, technological barriers. We've got loads at the moment. So I think it's sort of going through them one by one and then working together to unlock them is really what we need to do. I do think, the more we're aware of climate risk, then the more you can start to answer these questions. So it sort of starts with this: how do you sort of build the demand? Where you push everyone understanding their climate risk more? And I mean, if you think about some of the market imperfections that are driving these barriers, you've got not pricing in positive externalities. The other is this lack of data and this sort of asymmetry of information at the moment. So you've got, maybe the financial sector understands climate risk more than if you're a rural business or a farmer. Maybe you don't quite understand it. There's a mismatch at the moment. So that's something I think that needs to be addressed. Just sort of people understanding the risk of climate change on their own home and then their business. And then I think the other is, there are two things. This is just kind of barriers, and then I think there are solutions that maybe we'll come on to them. But, the imperfection of financial markets that are looking for short-term returns, perhaps, when these are long-term issues. And I'd love to hear Rob's thoughts on that for sure. So they're just a couple as a sort of starter for 10.
Okay.
Thank you.
No, all typically good points, and I agree with them all. I mean, dangerous territory on the last one. So I was speaking of personal capacity. So it's not ducking the question. I think there are different types of asset class, and different asset classes have different temporal profiles. So it depends which type of investor is appraising a long-term investment. We're mostly talking about unlisted markets, private markets, quote unquote, and I do think that there is a tolerance for longer time horizons. I think one of the main issues, though, is that if we're kind of being absolute in this space, some of the time horizons we're talking about are kind of a century. So so it depends what you mean by long term. So if you're saying long term and you're thinking 10, 20 years, I'm thinking, yeah, there's plenty of capital out there. But if you're talking about capital considered for a century, that is unusual. I think that's when we get into the very technical space of you can facilitate the same effect contractually, but I won't go into that kind of rabbit hole. Helen listed all the main obstacles. I think a really key one. Obstacles too negative a word. I think a really positive thing that could happen that would help to unlock this would be if I kind of had an image in my head of how what's the relationships we like to have with local stakeholders, and how would we like to, if we were given free rein and we said, right, we want to be able to scale up these markets massively, what would want to happen? I do think they need to be, they'll always be kind of region specific, and you can pick the scale, whether it's landscape scale, or whether it's local authority scale, or whether it's kind of catchment scale. There's different levels, but there is some element of kind of, we're not talking about national strategy. We're talking about region specific plans. Lots of work going on, I think, being led by various government agencies as well around kind of local recovery strategies, but some kind of, I'm imagining some kind of mapping of every local authority, a kind of GIS mapping, and then that would be done with ecologists and relevant experts who would then be able to essentially create this kind of color-coded map for opportunities for investment into things like peatland or woodland or whatever it might be, NFM schemes, hydrological risk models, all overlaid. And then the bit that we're missing would be, there'll be certain opportunities that would be realized quite quickly, I think, as a result of that, assuming that there is, again, a kind of the carbon markets, quote unquote, or that the price of carbon actually goes up to where we all think it needs to be, or at least where, as I said before, kind of integrated assessment modeling and climate science seems to assume it will have to be, which is, much higher than it is today. Again, I think one of the missing pieces, though, there would be, it would need to sit down together with the relevant local stakeholders, and it probably will be local authorities, and come to a view on how to price and value the benefits. That is a key. That's one of the key unlocking mechanisms. If I won't say all local authorities, it's not about local authorities. I think also to Sam's point, my starting point, I was trying to craft strategies and the things that we're looking into is very much being cognizant of the 10 years that local authority just had of austerity. And I think this is a kind of idea, you don't want to be going to a local authority saying, please, can you pay us some money for a half-defined nature-based solution when you haven't got money to do very, very basic services. So very aware of that. And so it's not about saying, can you please facilitate X, Y, and Z, but it's actually about, can we sit down together and work out if you're actually saving money? Can local authorities save money through kind of minority financing at scale, this kind of mitigation and resilience work? And I think the answer is probably yes. It requires that. It's just a change of thinking. It's just an ability to meaningfully believe in those kind of tier 3, tier 4 benefits. I think other things that are not obstacles, but Helen's completely right about kind of the regulatory obstacles and these things that exist. But I think something that's interesting of late, which again is a rabbit hole I won't take us right down, but is carbon codes. So we sponsor, we try to get involved as much kind of academic research as we can because we evaluate in its own terms, and I'm a bit of a SUD anyway. But one of the things with carbon codes, I think, is that there's a good story, which is that they're multiplying rapidly, and that's fantastic. But one thing I have noticed, and I think this is legitimate, is that as these markets are beginning to kind of pick up, and you mentioned the woodland carbon code, actually, there's a moment at which I think some of these organizations that manage the carbon codes that have been historically quite small, suddenly come under a lot of pressure, activity is increasing massively, and there's a concern that perhaps they are facilitating the wrong kind of activity. And I think one of the potential obstacles would be what we call the regulatory perimeter, the kind of carbon codes confusing financial additionality with climate and or ecological additionality. And more broadly, you could just say carbon codes kind of reactionism, I think, from within, driven by legitimate concern, but done too quickly within these codes that actually determine outcomes over, as Helen said, like, a century, very, very long period of time. That's the kind of thing that could seem very small, like a very small technical detail, but could fundamentally undermine the ability of capital to have some sort of certainty over the contractual certainty over these very, very long time periods.
Mm-hmm. Mm-hmm. Interesting, actually, you both mentioned, thank you very much, Rob. You both mentioned about the availability of data, and I'm sure that map idea that you put across is going to be someone's project, PhD or initiative soon.
If anyone's watching and wants to do that and needs some money to pay for it, please do come and speak to me if you want to build a GIS of the whole thing.
Excellent. I think there are some models, and that's another barrier, that there is a lot of data sitting in somewhere, and there are a lot of these models, but it's hard to disseminate them. And if you can't do this at the very UK level or global level, can we do it locally, Sam? Is that part of your barriers as well?
It is, yeah. I think Helen outlined some of those barriers, those key barriers, and as Robert was saying, it's really about the capacity and a local role in bringing all of that together, to bringing people around the table to tackle those barriers. The local area's role in setting the priorities, understanding the landscape, what is required where to tackle the adaptation risks that need to be mitigated, to develop the projects, to support the development of the projects that can do that, to bring different partners together around the table, and to understand their drivers and priorities across different organisations. Data sharing is a key thing in that, in understanding what drives them, what drives different organisations and their priorities. We find that all the organisations are operating to different planning horizons, different planning timescales, and are developing plans to tackle adaptation, but again, two different timescales. You've got water companies developing their drainage and water management plans to one timescale. We'll be developing a local nature recovery strategy next year in response to the Environment Bill, coming at this from a slightly different perspective. There's also, river basin management plans, the EA's, Environment Agency's investment programme, more general infrastructure investment, all happening at different timeframes, scales, being driven by different priorities, underpinned by different data, and the role of local areas in bringing those stakeholders around the table together to share that information, to really understand priorities and drivers, is absolutely crucial to doing that. And as Robert was saying, that understanding the real value of the different ecosystem services and wider benefits in a particular area, and understanding the real value and starting to put a price on those. So it's really about that convening, that capacity, and those conversations that bring those interest groups together at the right scale to discuss and bring forward projects that are actually going to deliver on the ground.
So we are working on the natural environment agriculture field, at least on the sort of principle of public money for public goods. But we're thinking about that in terms of kind of environmental public goods. But perhaps I'm hearing bringing stakeholders together, sharing information is a public good in itself, and perhaps there is room for investment. Not perhaps, actually, I think there's a strong gap for investment in that of public money. Thank you so much for engaging my questions, and I think we picked up some of the Q&As from our participants. I'd like to go to David, actually, because there are a couple of questions in the Q&A that require his clarification from CCC's messaging. David.
Thanks, Ece, and yes, thank you to everyone for their questions. One of the questions we received was just asking to clarify what I meant by lock-in. By lock-in, I mean where decisions that are made now can create additional costs or irreversible change in the future. So some particular examples of this would relate to assets with long lifetimes, so infrastructure and buildings, where if we don't ensure those assets are resilient to the impacts of climate change and consistent with net zero goals, then those costs are locked in effectively. And then another question was on the focus on 2 and 4 degrees and if that meant the 1.5 degree target was gone. And no, the reason why we say 2 and 4 degrees is because that's what most of the historic climate impacts literature looks at. And in fact, because of the uncertainty in climate projections, there's considerable overlap between 1.5 and 2 degrees. So just to clarify, no inconsistency there. Thank you.
Thank you very much. That's a very important point to clarify. I want to go to the most voted question in the Q&A. I have to. David Denoon asks, and I think perhaps it comes to you, Sam, at least first, in finance and pensions, the role of how are pensions invested. There are also other questions they are asking. We're talking about investing in adaptation, but we're busy investing in things that actually make adaptation even a bigger challenge. So start with pensions. I know you're not a pension expert, but what's the view from the local authority? And Rob and Helen, you can come in as well.
Yeah, not one of my sort of areas particularly of expertise, but I know the government has brought in measures to ensure that trustees are legally required to assess and report on financial risk of climate change within their portfolio. So I think it's at a national level that these sorts of issues of pension funds investment and the considerations that need to be brought to bear there are that's the sort of right level for that. There has been a degree of divestment within Greater Manchester, although it is it is along with the airport one of the particularly difficult issues that we get criticised for and have to manage, and it is one about which there are sort of regular conversations going on about how that aligns with our 2038 target, but also obviously of the duties of the pension fund to its members. So not a particularly straight answer, but one that is a complicated issue, one that is having live discussions and with leaders across Greater Manchester to work through.
Thank you. Helen, would you like to come in, or Rob? In the general point of comparative investments, if you like, or the pension point.
Go on, Helen.
Rob will know more than me. I'm a bit further away from pension funds, but my sense is that when TCFD is mandated, then that will obviously help too. Although a lot of people are disclosing voluntarily what their risk is, it doesn't mean that they will then change their investments. Unfortunately, that's what we will hope for TCFD. It doesn't mean that's going to happen, but disclosure can certainly help. And then TNFD also on its heels. I think that there is a lot of push, I know, around deforestation-free pension funds at the moment, which I think we really need to be thinking about, because I don't know if my sense is no, that the data that we have of the projections of where we're heading in terms of warming, whether that takes account for carbon sinks remaining the same, or whether it's taking into account a reduction in carbon sinks, which is where we're heading at the moment. And that is that's what keeps me up at night, I suppose, as well. So that deforestation, I would like to see a lot more stricter rules around that within portfolios, but I'm a bit further away from it than probably Sam and Rob.
So I think I sort of take things for granted on this. I always should explain to your audience. So when I said an institutional investor, we manage pension fund capital. That's mostly what we do, is that we are, and actually one of the nice things about, one of the things that I think would be a good outcome on nature-based solutions that we talk about today would be, you have this virtuous circle where you have a place-based strategy, and you have those actual local authority pension schemes investing in increasing the climate resilience adaptation of those areas and generating a suitable level of return. So when I'm talking about the kind of how to make it feasible, it's how to make it feasible for pension funds, exactly that. I think my own personal theory changes. I think it's a really good question, because I think if you want to change the world most quickly, increasing the transparency or increasing people's awareness and salience of what is going on with their pension is probably, apart from a global revolution and creating a one world government, probably the fastest way to having some kind of change in the world. I think there's lots of bits and pieces going on and moves and initiatives being going on to try and increase the kind of give people more salience of the fact they have this allocation and that things are being done with it. I think that's a really good thing. We do a lot of work on deforestation. Very cognizant of that. as well as lots of other bits and pieces. So I don't know if the question was specifically, can pension funds be doing more? I think pension funds are doing okay. I mean, I've got a bit of a bias, but I think actually you tend to find that local authority pension schemes and other institutional pension schemes, I have to say, tend to be very switched on actually about this, and they're asking questions like Helen was saying about, well, can you show me your scenario analysis for various different temperature outcomes and the implications there around requirements for investments into carbon sinks, for instance. So I think actually they're the kind of end investors that are at the moment driving this alongside philanthropic investors.
Thank you. And I guess there's a question about the timeframes. And I guess pension investments are interested in longer term timeframes where the investment timeframe can match more easily to climate projection timeframes. Is that right, the way I understand that?
So this is the world of what's called asset allocation and how this is determined and how pension schemes calculate where and what they allocate their capital to and for how long is extremely complicated. But it has, I guess, a simple single metric, which is the liability that the pension scheme has. But in broad terms, yes, they can invest for longer, quote unquote, timeframes. I was thinking, as Sam was speaking, that maybe instead of attempts to go through everyone's individual timeframe and see how they aren't aligned, one of the things we're already talking about, a kind of a market for nature in terms of the underlying asset classes. So I hesitate to add another market, but one of the ways you could simply sort of get around this is you could imagine Greater Manchester or anyone else, sorry to pick on you all the time, Sam, but you can imagine Greater Manchester having its own, essentially a kind of a place specific, we've got a platform, but it would basically be a secondary market trading units of each of the underlying. And that means it doesn't matter if the water company had a different timeline to someone else, because it just generates liquidity and people can move in and out of those units, and each one representing basically a token or a credit or a portion of those investments. Just an idea. I'm sure Sam's building one of those in his spare time anyway.
It's a part of your day job. No, Sam, not spare time. But yes, I think there is a link there to kind of natural capital accounting that you mentioned, Rob, in that understanding what you have, what assets you have that anyone can invest in, and what are those assets doing for you and for everybody else, and how is that benefit provision going to change under different climate futures. Perhaps it's easier to do when we just concentrate on what we're investing in rather than trying to please everyone and satisfy everyone's need for certainty or evidence. You can't please everyone all the time, right? Is that whatever the phrase? Cool. Okay, we're very close to the end. I hope we picked up some of the questions. There were a lot of very interesting questions. We couldn't have covered all of them in 1 hour, but it seems it's a lively and interesting discussion, and I'm sure the committee would want to continue to engage in this topic as much as we can. I want to close with one final question to each one of our panelists, and David, if you want to come in as well. And Robert, you mentioned that climate resilient UK may not be a clear picture for everybody, or it might mean different things to different people. But whatever it means to you, what would be your priority investment? What would you invest as a priority to achieve a climate resilient UK?
Good question. Very unfair question there.
It's in a personal capacity.
In a personal capacity. Okay, purely personal, and this is just my own bias, I suppose, as a Dalesman, but I would suppose increasing significantly by orders of magnitude the quantity of proper extensive green space, so kind of almost like a national park style scale green space, and the integration of that with urban development. So the ideal kind of green village, if you like. I think integrating nature with our urban environment as quickly as possible is a world that I would very much like to live in.
Sounds good.
Not sure it did sound good.
I think for me, equitable access across different communities to quality, sufficient green space that is also reducing their exposure to climate risks. It's reducing their exposure to flooding and to heat, whilst also providing them with spaces for their physical, mental health and enjoyment.
Thank you, Sam. That also sounds great. Helen.
Yeah, I like Sam's. Can I just go with Sam's? But it's a bit of a left field. I suppose I would invest in the data and education piece. I just don't think we have done enough to let people know the kind of risks we're facing that we know, but I would say 80% of my friends and family don't know which, and like they're educated people, they don't know. And I just don't think we've done a good enough job of it. So I will throw that in. That's where I would put it in.
Thank you very much for indulging me in that last very big question and challenge. Thank you so much for to our panelists and David as well for joining us today, and all of you for attending. I have to wrap it up now. We could talk for much longer, but on that data and vision issues, that the deep dive webinars continue. The next week is on 6th of October. The next webinar is on role of business, and I hope, and I'm sure we'll pick up some of these topics there as well. And have a great rest of your day.